Hello everyone, thanks for joining. Today we are conducting a webinar on ESOP liquidation where you can navigate the way from ESOP allocation to wealth creation. So we are honored to have two speakers with us today, Mr. Abhishek from LTS Investec and Mr. Manish from Vega Equity. We'll be giving a brief intro of our experts. Mr. Manish has 8 years of experience with background in corporate finance, financial reporting, and investor relations. He has worked with major unicorns and big startups such as Blue Dart, Delivery, FireEye. So he's by profession a chartered accountant. On the other hand, Abhishek, the co-founder at LTS Investec, has 10 years of experience with specializations in alternate investment, financial analysis, and corporate finance. He has also worked with renowned organizations like PwC, ITC, and Marico. So, welcome on board, Mr. Manish and Abhishek. We'll be looking forward to have an insightful session from your side. Thank you so much. Handing over to Manish.
Hey, thank you, Sanya. Thank you, Anushka, for arranging and initiating this wonderful session. Welcome, everyone. Thanks for waiting. Thanks for registering here, and thanks for joining. Before we start today, the context has been clearly set out by Sanya. So today we are covering about the wealth generation from ESOPs, right? So most of the ESOP holders or the stakeholders in industry, they have ESOPs in hand, they have vested ESOPs in hand. Now they are in a dilemma whether to exercise or not. And even after exercising, they have a question how to create the wealth, or how should I liquidate, or what are the ways for me to liquidate, right? So before moving ahead, I have a humble request with all our previous attendees as well. There are some people who are following our webinars continuously every month, and they are joining this the third webinar continuously. So please bear with us and bother with us with the same example. We are just briefing our new audience and the new attendees here about a brief about the ESOPs and how the entire life cycle is all about. And I would like your attention here. And before I hand over it to Mr. Abhishek, right? So, as a ESOP holder or the option holder from our organization, we have ESOPs in our hand. But for the very first time when we receive it, we thought what it is, right? So to clearly explain it here, it is an instrument or asset which is given to you by your organization because you are an employee there, right? And whose market and which market value can be 10x or 100x from the existing price, right? Now take an example of a Honda City car. Assume Honda City car is a ESOP here. So the market value is 15 lakh rupees, but your organization asks you, if you stay in the company for next 4 years, you'll be able to get this Honda City car in your name, or the car will be yours by just paying 1 lakh rupees, right? So now you are generating a profit or a wealth of say 14 lakh rupees, which is a differential between the market value and the exercise price, the price which you need to pay to your organization in order to convert those ESOPs into equity share, or the price by which you will be converting that asset into your name, right? So this is a basic example of ESOP. We can move ahead, and then there are certain stages in the entire life cycle, right? The at first our organization launches a ESOP scheme or a stock option plan, right? Of the plan, once it is launched, organization starts to allocating options to its eligible employees, which is called ESOP grant or ESOP allocation to their employees. Now, basis your ESOP scheme and basis the vesting schedule, your option keeps on vesting every year or semi-annual or a quarterly basis your vesting schedule, right? Once it is vested, organization gives you an option to exercise your vested option, right? So, for example, you have 1,000 ESOPs with you. Now, today you have 700 options vested. Now, organization asks you to exercise your vested option, so you can exercise maximum of 700 option or 400 option, whatever you decide to go ahead, by just paying the exercise price money and the perquisite tax which will get arise when you will be exercising it. But what next? What after that, right? Most of the employee have this question in mind: why should I exercise early when I am not getting anything in hand, because my company is not launching the IPO, my company is not giving me an immediate liquidity option, but they are asking me to exercise. So first of all, it's not an obligation, it is a right of an employee whether to exercise or not, or whether to accept it or not, right? But in case you have exercised your vested option, so the first question comes in your mind is, when the liquidity will come? I have already paid my exercise price money. The perquisite tax, which was a huge amount, has been deducted from my salaries, but now how should I liquidate? So now I welcome Mr. Abhishek Ginodia here to this webinar. Welcome, Abhishek.
Hi Manish, thank you.
Hey.
Thank you for having me here. Thank you for the wonderful introduction, Sanya. Uh, Good evening, everyone. Thank you for joining in and taking time out on a busy Tuesday evening to sort of come here and get an understanding on ESOPs from us. Taking over from Manish, I think ESOPs is a wonderful tool, right? I mean, there are no two thoughts about it. We've seen how people who were early in employees in Infosys, in companies like Wipro, over the decade, they had made a large amount of wealth. There are so many news articles which you keep on reading. When Flipkart will go for an IPO, there'll be 100 crore patis which they will mint. And all of these news are essentially coming because of this particular instrument which we are currently talking about. Now, if we see the life cycle of an ESOP, typically the first stage is when the company decides that yes, an ESOP scheme is required in the company. The second stage is to allocate some shares to your name. The third stage, like we discussed in the previous slide, was to actually get the shares into your account. And the fourth stage is what I am going to build upon further is liquidation. So now that you have the shares or you have the shares to your name, what do we do with it? And that's what all ESOP liquidation is about. Because getting shares is half of the journey, but liquidating the shares and getting funds against those shares into your bank account is what actually helps you complete the cycle and use those funds to achieve your financial goals. Uh, can we move to the next slide, please? Sure. So now let's first understand that uh, you are a employee or you are part of an organization which has given ESOPs. They got vested, you exercised, and now you're holding those shares in your account, right? Now, you would at some point want a liquidity. In a sense, you would want to sell those shares somehow and be able to realize that shares as money in your bank. Now, typically, as you can see on the slides, there are three typical ways to do it. The first is when the company goes for an IPO. Whenever a company goes for an IPO, the company allots a certain portion of the OFS or offer for sale as a part of the IPO proceeds, wherein the existing employees who had exercised their shares and are holding shares in their demat are able to exit as a part of the IPO share sale and are able to essentially pocket the increase in value from when they had entered to when they to whatever the IPO price is. The second method is an ESOP buyback. Now, what happens in an ESOP buyback is it essentially is a corporate action which is done by the company itself. As in, the company itself decides that, okay, we have not gone for an IPO, we have not done a follow-on round, but our ESOPs are now aged, and therefore we should figure out a way in which we can get these employees a certain amount back in their bank account. Now, this happens time to time and it is not mandatory. So it is only done if a company wants to do it. There is no mandatory requirement for companies to do it, or nor is there any clear timelines. कि आज हो गया, तो when will it happen next? No one knows. So it can happen in the next 6 months again, or it might not happen for the next 6 years again also. But essentially, in case of an ESOP buyback, companies are acquiring back the shares from the employees and paying hard cash back to the employees against the shares. The third method, which is on the right, is secondary buyout. Now, typically what happens is if a startup is raising multiple rounds, VCs or incoming shareholders would typically put in some money, not just into the company's business, but they would also put in some money which allows them to buy these ESOPs, right? So for example, we have put an example, Ola allows ESOP encashment after Temasek acquires shares. The idea is, say if a VC fund is putting in 100 crores, what they will essentially do is they will put in 80 crores primary into the company, which is money which goes into the company, and new shares are created and allotted to the employees. And the remainder 20% they would keep for buying out the shares of the existing investors. Now, they may be angel investors, they may be ESOP holders, but essentially these are secondary shares, as in shares which are already held by someone and are not being created afresh by the company. Now, let's understand that with all of these three scenarios, there are two problems. The first is probability of this happening. So, like I said, all of these three options, IPO, buyback, and secondary buyout, these are dependent on the company or the investor or the market. So, there is no clarity if it will happen for everyone. And typically, what we have seen is that if 100 companies have given out ESOPs, only 5% companies are able to give an exit to their employees through one of these three routes. Now, because Indian startup ecosystem has progressed, there are a lot of companies which have been in this space for the last decade, have given out ESOPs, and their ESOP value has also gone up. But because these events have not happened for such companies, therefore the employees or people who've put their blood, sweat, and tears into the company have not been able to make an exit. Second problem is, even for companies where this will happen, there is no clarity on when will it happen. So you don't know whether this exit will come 2 years from now, 2 months from now, 2 days from now, or 20 years from now, because no one can control these objectives. This is dependent on market cycles. It's dependent on investor temperament. It is dependent on the company's performance. So there are too many variables at play, which makes determining timelines very difficult. Now, a very real life example. Say you have been invested in, you started working for a company, one of the good startups, maybe it started 2010, and you've been there for the last 10 years. You've made a very good substantial portion of your earnings is through salary, or their compensation is through ESOPs. And those value of the ESOP has also gone up. But you have some financial obligations which you want to meet in the future. You might want to buy a house, you might want to buy a luxury car, you might want to take a travel abroad, but essentially you're not able to liquidate these ESOPs and fund these financial goals. That is the basic problem that we are trying to assist with. And we've worked with so many cases in the past. And just for example, like when we used to work with Paytm, there was someone who started working with Paytm back in 2008 or 2009. That's absolute the early days of Paytm. And he was a regular middle class guy from Delhi. And when we spoke to him, he had Paytm ESOPs worth 75 crores to his name. But at that point, Paytm was not listed, and there was no way that he could have liquidated those ESOPs and figured out a way to sort of buy the house which he was wanting to, or buy a car which he was looking to buy. And that's where sort of Altius steps in. What we essentially do here is we try and create a secondary ecosystem in such ESOP shares, and we find buyers on the other hand, investors on the other hand, who want to invest into companies, who want to take on the risk and return going forward, and are able to provide a certain exit to the existing employees. The third problem with this delayed option or this delayed ESOP liquidation is something called option lapses. Now, what is option lapses? Typically, how does a general ESOP plan work? You are given, say, X number of shares or X value of share for every year for which you are in the company. And at the end of 2 years or 3 years, you're supposed to put in a certain exercise value into the company, and you are given the shares or you exercise the shares and you get the shares in your demat account. Now, typically what happens is, as the employee has stayed with the company for multiple years, every year a substantial outgo of funds happens because he needs to buy out the further options. And that is the example which we have shown in the table, which is visible on your slide. So the example basically shows that, if you had 10,000 shares of a company, 1,000 rupees a share, and you had 25% vesting annually, what you would have to pay is given in the fourth row, or the exercise cost row. So 7,500 times 1,000 plus the perquisite tax on that will have to be paid to the company. Now, typically what happens is, because the employee has not been able to liquidate his previous holdings in the company, it becomes a little challenging and financially not so prudent for him to sort of keep on pumping money into the company, into an illiquid asset. And therefore, what people do is people let their option lapse. What option lapsing exactly is, say you were allotted ESOPs in 2010 and you were given an exercise period or a vesting period of 2 years. So essentially, you're supposed to exercise the ESOP from 2012 onward. If you do not exercise it from 2012 to 2014, essentially in 2014, your ESOPs will lapse, as in whatever hard work you've done to get those ESOPs will essentially go down the drain because you would have not paid the company and sort of gotten these ESOPs. How ESOP liquidation helps is because you have liquidated your previous holdings, the employee or you are in a position to essentially pump in more money into the company, buy newer options, and sell it again in the secondary market. Go back to the company, take in your further options, acquire them, and then again sell it out in the market. What this essentially helps is it does not let your hard work go to waste. It does not allow your options to lapse. So this we have seen happening very frequently in the largest of the organizations. And we are talking about organizations which are maybe valued at 10, 20,000 crores plus. And we have seen just because of illiquidity, there are many employees who are not exercising these options. They are letting them lapse because they do not want to take a heightened risk by keeping on investing into the company. So I think these are the main areas wherein ESOP liquidations sort of help us protect the employee's interest. They help us protect your capital, and they help us make full use of all of the virtues of ESOPs. Now, quickly covering how ESOP liquidation happens. So the first step is option exercising. So like Manish had discussed, essentially the company first allots you options. You then are given a vesting period for which you have to stay in the company for you to be eligible to buy those ESOPs. Then you exercise the options. Then here on out, once your options are exercised, you are now holding the shares either in a physical format or a demat format. This is where the ESOP liquidation journey starts. The first step is to do a preliminary discussion and planning, getting to know the company, getting to know what kind of ESOPs are there for sale, what is the valuation of the company, understanding what kind of investors would be interested. Then the third step is doing due diligence by Vega. The fourth step is doing evaluation. Company evaluation basically contains sort of is a summary of understanding what the company does, what is its plan to go public or a plan to go secondary, how has the company performed in the last couple of years, and trying to determine a valuation for the company. The next step is the investor roadshow. Typically here what happens is we create certain decks and understanding on the company, and then we take it to potential investors that this is the opportunity at hand, and we get a feel and look and feel of how the market is responding. Once the investor roadshow has happened, then we would possibly come back to the management of the company, make sure the management is on board. There are approvals in place, there are guidelines in place, how much ESOP can be liquidated, what can be the floor price, what can be the timelines for various liquidation rounds, how frequently can we do it, is all of the investor approval in place. So all of that happens as a part of step 6. And step 7 is executing the transaction, wherein essentially the shares are transferred from the employee to the investor, and the investor, in a sense, transfers the funds from their bank account to the employee bank account from which the transfer of shares have been made. So this is an overall journey on how an ESOP liquidation happens. Typically, we've seen ESOP liquidations take anywhere from 30 days to 120 days to plan and execute from the first day 1 to day 0. Now, and we've done this with multiple companies. We've done it with companies which are subsidiaries of very large companies, say subsidiaries of Tata, subsidiaries of Reliance, subsidiaries of ICICI, which have not gotten listed yet. And we've also done it in the startup ecosystem, companies which are valued close to north of $100 million in valuation. We've tried and created a secondary market in these companies. Now, quickly covering the benefits of liquidating for ESOP holders. 1, unlock the value of equity. Now you've worked in the company, you've got ESOPs, ESOPs values has increased, but there has to be an unlocking which has to happen for you to actually sell those ESOPs and get that money in your bank. Second, tax benefit. What happens is typically if you are able to liquidate every year, if you are able to vest your shares every year, exercise them, and then keep on liquidating, you can better manage the taxation aspect of your entire ESOP journey. As opposed to accumulating all of the ESOPs, selling in one single financial year, the entire tax burden comes on the employee in one financial year. Contrary to that, if you are able to sell it on a recurring basis, you can actually spread over your tax bill over multiple years and therefore optimize your tax payout. Third is financial flexibility. Essentially, selling ESOPs allows you to be able to be in control of your finances, diversify your investments, be in control of your financial goals. Essentially, plan when you would want to sell your ESOPs and use that money for your other life goals. Quickly covering ESOP valuation. Now, if we are to liquidate ESOPs, obviously we need to ascribe a valuation or a pricing to the shares. Now, just trying to cover or give you a brief understanding on how that valuation happens. One is financial performance, how the company has performed, how the revenue has grown, how the profits have grown. Industry dynamics. Is the industry in vogue right now? So is it a industry which is highly sought after by investors, or is it an industry wherein the valuations are typically low or the growth is low? Third is market position. Does the company hold a pole vault or a monopoly position? Or is it a market wherein they do not have any pricing power or they don't have control over the market? Fourth factor is promoters and management. How have the investors fared? What kind of investors do they have on the cap table? How have the founders run the ship? Is it a tightly run ship, or there is a lot of chances of money being siphoned off? And lastly, growth prospects. How does the company plan to grow from here? So mix of all of these factors is what contributes to determining the price of your shares. ESOP taxation. So now this is an interesting slide, which I think we've at least seen that most people do not have a very clear idea on what kind of taxations are applicable. So just to give you a very bird's eye view of ESOP taxation, essentially, there are two levels of taxation. One is a perquisite tax and the other is a capital gain. Perquisite tax is what is deducted from your or collected by your company when they're allotting you the shares. Now, how does this happen is, let me sort of illustrate with an example. Say you joined a company or a startup. The startup gave you shares at 10 rupees, 10 rupees per share. And this was done in 2010. Now, 5 years later, the company said that now you've been in the company for 5 years and you can now exercise the shares. Now, on that day, the company's market cap had increased and the fair market value of shares was 100 rupees. So essentially, your perquisite tax is calculated as 100 minus 10 into the tax slab, wherever you're falling. And this money is collected by the company as a part of your exercising proceeds. Now, say you have acquired the shares from the company at a fair market of 100 and you have taken these shares in your possession. And 6 months later, you go and try and sell these shares in the market and you are able to sell the shares in the market at say 500 rupees. So capital gain will be determined by 500 minus 100 equivalent to 400. So essentially your capital gain is the price at which you are selling. Subtract from that the fair market value which was incurred at the time when you had exercised the shares. And this is then classified as either it is short term or long term, basis the whether the company is now listed or it is still unlisted, and basis that the taxation is decided. And how the taxation is decided is basis the table which is in front of you. I will not go too deep into this because it is very easily available on the internet. But essentially, taxation is on two levels. You got the shares at 10 rupees. When you got the shares in your account by the company, the price was 100. So perquisite is 100 minus 10. Capital gain is when you sold the shares at 500, but your FMV was 100. So 500 minus 100, 400 is your capital gain. And the taxation on that is decided as per the table on the screen. ESOP financing. Now, this is again an interesting angle on which we are working. The idea is that whenever people of companies which shares are already listed want financing to acquire those ESOP shares, they are easily able to go to an NBFC where there is a preset agreement and they are able to essentially get a funding against their ESOPs. This option is typically not available in case of startups and for companies which are unlisted. The idea is that Altius and Vega will come together and we will try and provide certain options which allows people to get a financing on their ESOPs. In a sense, say when you go and try and exercise shares from your company, and the company says that, to get these 1,000 shares in your account, you need to pay me 20 lakh rupees. ESOP financing essentially helps you to get a NBFC or a bank to fund that 10 to 20 lakh rupees to you so that you can pay that to the company and you can get the shares in your account. Later, you can sell those shares and get the proceeds from those shares and then pay back the NBFC, whoever is acquiring, whoever had given you the funds to acquire those shares. So that's in a brief summary what ESOP financing is. Now, lastly, I'll try and quickly cover, I'll just do a quick time check. So it's about 3:30. So I'll maybe take only another 5 minutes to complete the deck, and post that we will open up the floor for, you all to post your questions. Now, lastly, what is happening is how does ESOP liquidation help as an organization? So this is from a perspective of a HR partner or from a perspective of a founder. One, it allows you to stay private longer. Essentially, it does not force timelines for you to go for an IPO because you are still able to give your employees an exit in the private secondary markets. Attract and retain talent. Essentially, because employees are able to sell those ESOPs which they are getting, they are essentially able to improve the quality or the appeal of their ESOP plan. Because ESOP plan is then not just on paper, but it is essentially a very concrete solution which they can provide their ESOP holders, and they can actually liquidate those ESOPs on demand. Third is on-trap primary financing. Because there is a secondary ecosystem, there are more shareholders which know about your company, which are interested in your company, and therefore you can tap those same people for doing primary rounds as well. Fourth, provide executive and investor liquidity. I think this you've already covered. And last, you also understand what kind of valuation is your company getting in the secondary market or in the investor ecosystem. And it helps you later price your follow-on investing rounds, or also helps you determine a better pricing when you do plan to go for a public listing or an IPO. This is a slide which essentially brings everything that we have discussed together. One, for organizations, what does this ESOP liquidation help with? For employees, how does it help liquidating the shares? For an investor, how does it help you to get access to newer companies, diversify your portfolio, get access to some high growth companies at some early stages? So this essentially creates a nice, well-molded ecosystem for organizations, for employees and shareholders, and for investors. And when all of these three stakeholders come together, is essentially when we are able to solve for everyone in the ecosystem and make everyone's wealth creation journey, financial goal planning much, much smoother and better. I guess that was what we wanted to cover. The attempt was to try and give you an overall brief in 10 to 15 minutes so that we can now try and answer whatever questions or queries you might have. Over to Manish, if you want to add something to this. Thank you.
Yeah, thank you so much, Abhishek, for this brief and a very detailed understanding of things about ESOP liquidation. Right, as a ESOP users, I will give my own example, and people here joining the session can relate very easily. Right, there are multiple stages, and due to unawareness or due to a lack of information, most of the time we feel like we are lost. Right, and actually we are not lost. There are always solutions available in the market, always solution providers available in the market. It's just like we are not maybe finding or maybe approaching the right way, or maybe our organization at some point in time, they're not conducting proper or appropriate routes for training and awareness for those employees, right? I will not name, but I'll tell there are a lot of organizations, they launch ESOP just for the sake of launching it, because n number of other organizations have also launched, or maybe my some top employees are asking me to allocate or grant ESOPs. Let me prepare a ESOP scheme. Just I'll launch it anyway, right? And I do not have a visibility, and neither I can give that kind of a visibility to my employees as well. But for employees, if you are sitting on the other side of the table, right, I am working for an organization, I have fixed CTC there. What is it as an incentive, or maybe as a long term or short term rewards, I hold those ESOP for my long term wealth creation. But what at the end, if you go to your bank and if you are clicking on a redeeming your FD option, if bank says you cannot redeem this FD for next 6 years or 8 years, will you find that you hold that FD in your bank account, or that saving account balance you are having? Similar way, when people feel, okay, I have a wealth of say 75 CR, or say maybe 75 lakh on the lower side, right, from the organization, because I hold these ESOPs. But when I go to that right window to liquidate that, when I am going to buy a house, when I'm going to have my higher education for my children's, right, and at that time when I knock the door, I come up with the answer that this is not the right time. Whenever the right time will come, we'll tell you. So the solutions are available in the market. Unlisted ESOP holders or shareholders shouldn't feel losted. Today, there are a number of ways wherein we can have a roadmap or a visibility how I can liquidate my ESOPs which are already vested, or exercise, or how I can plan exercising and selling my unvested options.